Delete the investment apps off your phone. You are psychologically setting yourself up to lose. Not because investing is dangerous, not because the market is fake, but because your mind was not designed to process thousands of emotional signals every single day without reacting. And the market knows that. Every notification, every red candle, every breaking headline, every influencer screaming "sell now," it is all putting you or pulling on your emotions. And emotional men do not build generational wealth. Long-term money requires long-term behavior. This is exactly why investors like Peter Lynch were so dangerous in the market. Not because he predicted every crash, not because he made or had magical powers, but because his framework was rooted in patience, simplicity, and understanding real-world adoption before Wall Street caught on. Peter Lynch managed Fidelity's Magellan funds from 1977 to 1990 and averaged roughly 29% annual returns during that run, turning it into one of the greatest performing mutual funds in history. But here's the important part most people miss. Lynch did not build his fortune staring at charts and reacting every 15 minutes like a crack addict refreshing prices. He looked for businesses becoming embedded into everyday life. He famously invested in companies like Dunkin' Donuts and Heinz because he noticed ordinary people constantly using the products. He called this investing in what you know. That is the mindset. You're waiting for the world to adopt something. You're waiting for it to become normal, household, everyday use, culturally embedded. That is when real wealth is made. Not from reacting to random daily volatility. Because long-term money requires long-term behavior. The average investor underperforms the market massively. Over time, largely because they panic. Panic buy and panic sell. Dalbar studies have repeatedly shown emotional behavior destroys returns more than bad stock picking. Think about how insane that is. A man can spend 200 hours researching a company, then let a 3% drop destroy his conviction in 3 minutes. That is not intelligence. That is emotional instability disguised as analysis. Peter Lynch understood something most modern investors never will. The stock market is not a test of information, it is a test of temperament. Anyone can download information. Very few can control their emotions. That is why the apps are dangerous. They train you to become reactive. Green candle, you feel invincible. Red candle, you feel like life is collapsing. You start checking in the gym, checking on dates, checking before sleep, checking during work. You are no longer investing. You are psychologically attached to fluctuations that have no long-term consequences. Meanwhile, the real investors are calm. He already did the research. He already understood the sector. He already knows adoption takes time. He's not worried because he understands the difference between price movement and thesis destruction. Those are not the same thing. A company dropping temporarily does not mean the thesis has changed. If supermarkets still use the product, if consumers still buy the product, if revenue still grows, if the sector still expands, why are you panicking? Because the app trained you to react emotionally. Delete it. Set one review date per month. Read earnings reports, track revenue growth, track market share, track sector expansion. But stop treating long-term investing like sports betting. And another thing, you should never be terrified of one position going to zero, because your portfolio should never be built like a casino ticket. Spread intelligently. Not all in on technology or energy or healthcare. Spread, ensure there's infrastructure, consumer staples, cash reserves. A king does not build a kingdom on one soldier, because long-term money requires long-term behavior. Peter Lynch once said, the stock market is designed to transfer money from the active to the patient. And that is exactly what is happening every day. The impatient man refreshes, the patient man researches, the impatient man reacts, the patient man reassesses, the impatient man needs stimulation, the patient man needs strategy. One becomes emotional, the other becomes wealthy. So understand this clearly. Your phone is not just showing you your investments, it is training your nervous system, training fear, training greed, training panic, training impulsiveness. And if your emotions control your investing, your emotions will control your financial future. Delete the apps. Build your thesis, trust your research, review periodically, think in years, not hours. Because long-term money requires a long-term behavior. Do not be